All right, well, let's just go ahead and start. It is right now 3 o'clock. Um, Today is Friday, September 30th, 1 hour before the New York Stock Exchange closes. We're just doing a special session today. I just wanted to go over some of the things that um, some of the things that are going on, right now, as I explained on yesterday and the day before, we're having a little bit of a currency and solvency crisis with the Bank of England had to intervene in their bond market. And so I just wanted to add some color to that. I had some discussions with some bank executives yesterday, and these are people that I respect their opinion, and they said some things that I think is worth sharing. So um, we'll go ahead and talk about that. Today is also the end of the quarter, guys. So I just wanted to give out this warning. A lot of people are going to receive their quarterly 401k statements, and it's going to show some large losses. All right. And so we may see some headline risks coming out of mainstream media and also social media as well. Mostly, the stuff that could potentially spook the markets is something that mainstream media says. So usually when these kinds of like quarterly 401k statements, they're when they come out really bad, you start seeing like places like CNBC and all these other media companies come out with more sensationalist news. So just keep that in mind, guys. You're going to see more of that probably in the coming weeks. So first off, this currency and solvency issue. Now, again, we talked about this earlier this week. I invite you guys to go to our playlist and go back and watch some of our earlier episodes this week. But yesterday, I talked to two sets of banking executives, one for a breakfast meeting and one for lunch. Believe it or not, I don't sit in front of my terminal all day trading, and getting abused by 1-minute candles. So I do a lot of private deals during the daytime. And so, I met with these folks, and these guys aren't some low-level managers or some small banks. These are guys from the respected names. Can't really share much more about that, but just know, what I'm about to share with you guys is not really all that scientific. It's in the end, it's anecdotal. So they could be wrong, and so could I. So you can be the judge on how much attention you want to put to this. Before we get into that, though, let's talk about the backdrop of what is going on. So earlier this week, we had the British pound and the gilt, which is their bonds, crash, and the Bank of England had to step in and use their foreign reserves to prop up the bond market. So the Bank of England bought longer maturity bonds, which is somewhat like yield curve control. The reason why they had to do this was because their national pension, which holds a lot of these bonds, saw their portfolio values get decimated and get into margin call territory. So basically, the Bank of England had to bail out the bond market in order to bail out the pensions. And these pensions were already on thin ice as these bonds started coming down in price. So remember, these bond prices have an inverse relationship to interest rates and yields. So, just here in the United States, here is our 10-year, okay? So you see how yields have been going up. So this has been the case with central banks all over the world, as inflation expectations are going up and the expectation for tighter central banks, central bank policies, you see yields going up, and which means bond prices are coming down, okay? This is kind of similar to, here in the United States, we have CalPERS and the New York State Employees Pension Fund. These pension funds hold a lot of treasuries and bonds. And so when yields were low, they leveraged up. Remember a couple of years ago here in California, people were talking about CalPERS getting involved in leveraged buyouts with, private equity. So it remains to be seen what happens here in the United States, but I figure it's probably very similar. I don't know that much about the British pension system, but I imagine with yields being at record lows, with all this quantitative easing since 2007, 2008, I imagine they're in the similar boat. They probably leveraged up to get extra returns. And so when some of these more quote unquote stable assets, longer term maturity bonds, when they start coming down in price because yields are going up, you can see how they could be in some financial problems. So anyway, the gilt crashed. They had to come in and bail them out. All right. So we've seen bonds all over the world face a bad year, with all this increases in interest rates. All right. Basically, the Federal Reserve is exporting our domestic inflation to the rest of the world. Okay, so as this happens, the dollar gets stronger as institutions can get a better yield in dollars, which is the reserve currency of choice and the currency with which energy commodities are priced. So as our dollar gets stronger, okay, so it costs other countries more to import energy. All right, so imagine here in the United States, most of you guys that are listening in are from the United States. We saw our energy prices go up, and you see a lot of people complaining about that. Their gas, their the fuel for their car, and all that. All these prices are going up. But imagine if you're in the Eurozone, you have euros. Imagine if you're in Great Britain and you have the British pound. You're in Japan. You're in the everything's priced in Japanese yen. Your currency has fallen 20 to 30% against the dollar. So whatever price increases we saw, they saw way more of it. Okay, just out of the currency conversion. All right. So, and all these currencies like euro, pound sterling, yen. I mean, these are major currencies. So central banks, they have two options when they want to prop up their currency. They can either raise interest rates or they can sell foreign reserves. All right. Foreign reserves the foreign reserve of choice is U.S. Treasuries. So who, out of all these countries, which foreign country owns the most U.S. Treasuries? Well, that's Japan. So you're also seeing Japan having issues. If you look at their currency, this is Japanese yen. So their currency has been free falling. From 2021, it's pretty much fell about 30%. All right. So their energy prices are skyrocketing. So and they also had to intervene, something that they haven't done since the 90s. They had to intervene in their market. They had to sell treasuries to get dollars, sell their dollars, and buy yen. All right. So that's what they had to do. And so that keeps driving up yields. All right. Here in the United States, our 10-year yield keeps going up. All right. And that keeps this vicious cycle of the dollar also going up. And so here is now where my conversation with these, executives comes in. All of them, are saying this. They're saying this in private. They're not saying this in the public. They won't. They're the banks that they work for. Their compliance departments won't let them say this kind of stuff to the public. But in private, they all expect the Federal Reserve to pivot within the next 90 days. And here's why. Because if they don't and the dollar keeps going up, so that right now there's this vicious cycle of yields keep going up and institutions keep buying more dollars to get more yield because all these other currencies are dropping 20, 30%. Why would you hold your currency if it's falling like that? So if you're a Japanese investor, if you're a European investor, if you're a British investor, why would you want to hold your currency or your bonds? Because the interest that if you're a Japanese investor, you hold Japanese bonds. Well, first of all, you're not really getting all that much, but even if you were getting anything, you're getting 20 to 30% less just because of the currency conversion, right? So there is really no incentive to hold your own currency and your own bonds. So that's the reason why the dollar just keeps going up. This is like a wrecking ball, all right? It just keeps going up. So the only way that the dollar won't keep going up is central bank intervention. Basically, the Federal Reserve. The Federal Reserve is going to have to intervene, or at least the opinion here from them is that the Federal Reserve will pivot within 90 days. Okay, they think it's going to happen soon, or else there's going to be a Lehman moment. Basically, England has, the Bank of England, the UK has already had their Lehman moment. All right. And it's just a matter of time, they say, until the United States gets that. And so the reason why I mentioned CalPERS and the New York State pension in the beginning was, at some point, it could be one of our pensions domestically that happens. And if something like that happened to, if something happened where CalPERS or the New York State Pension Fund had to be bailed out, I think that would definitely, that would be a major issue. Okay, and in order to stop that, they would, the opinion here is that they have to intervene in order for that to not take place. All right. So intervening means pivot, basically a Fed pivot. So the discussion was that that within the next 90 days, they think that the Federal Reserve is going to pivot. Some of them are considering doing some lobbying in order to get this as well. So there might be a little lobbying push from the industry to put some pressure on intervening in the next meeting that happens in November or the December one. All right. Yeah, I mean, there could be a pivot even before. But what if, so now it begs the question, if the Federal Reserve were to pivot, what are their options? Well, first off, most likely Jerome Powell is probably looking forward to the October 13th CPI report to see a drop so that he can possibly talk about cutting rates without, looking like an idiot and without losing the little Fed credibility that's left. I don't know if that's going to happen. We just had the PCE report come out this morning, and it came out higher than expected. So we have to, think about the possibility that the next CPI report, it may still not come out, that low. So in that case, what is their option? They may not be able to cut interest rates. What they might do is yield curve control. So what they might do is go ahead and start buying either the 10 or 30-year Treasury notes, Treasury bonds. All right, which would probably bring down, of course, obviously that brings down yield. That puts a cap on yield, and that might send the markets up, equity markets up. Okay, and this kind of goes on with our thesis. Back in June, I told you guys that I thought that, that the Fed was going to pivot sometime in November or October, November. All right, and I still think so, and I think this just kind of adds to that. Again, these guys, these bank executives are saying that they, privately that they think that that the Federal Reserve is going to pivot within 90 days, or else there's going to be major issues that cannot just be fixed easily. All right, there will be a point where it all breaks, and they're saying that we're very close to that point. And our liquidity data kind of showed that too. It hasn't really been improving. Even on big days when HYG was going up, we saw junk bonds still have very similar advances to declines. Right now there is just no appetite for risk, and I think with bonds coming down in price, a lot of institutions hold these treasuries as safety assets, and these safety assets have dropped 17 to 20%. So that puts a lot of companies pressure, and they I'm sure that a lot of companies and a lot of investment companies have probably already faced certain margin calls because treasuries are also used as collateral as well in international trade and in derivatives investing and trading, over-the-counter derivatives. A lot of the times those treasuries are used as collateral. So there you go. I do think that there's a very, very good chance, just because of the economic conditions that we're in and because of what's going on overseas with the UK, that we're going to see a pivot. All right, and a lot of banking executives agree. So I think, you know, to take that as you will, you know, and maybe they're wrong, maybe I'm wrong, who knows? But I think it's worth thinking about. You know, some of you guys that have, you know, some or heavy into positions, you may want to cut some of these positions. Hey, there's nothing wrong with staying in cash, all right, until this dust settles, all right? So I've been saying that since the beginning, just stay patient. If some of you guys have, you know, are trying to DCA into SPY, if you guys are dollar cost averaging, this may not be a bad opportunity to get that. All right. So, you know, we may see this rally if the central bank does, you know, if Federal Reserve does pivot come the November FOMC. If that happens, we're going straight up. All right. Now, here's another thing. Now, right now, already, inflation is what, 7-8%? So if they do yield curve control and pump more money into the markets, because yield curve control, when they buy the 10-year or the longer maturity bonds, they're buying, right? So that means they're injecting cash into the system. So if that happens, that means later on down the road, 2023, 2024, we might see double-digit inflation. Okay, and that goes with our thesis that we talked about too, you know, that this is going to take some time, some 5-6 years to handle itself. So they're going to kick the can down the road, pivot, all right, you know, to bail out pension companies, to bail out the bond market, whatever. They're going to pivot, but then with more money coming into the market, about a year or two later, we may even see some more volatility, even more of a need to raise interest rates even further, which would probably cause a global depression in the end. Okay, so if all these bank executives, because you know these bank executives, even if they're right about this, they're wrong about the bigger picture too. All right, they're still being wrong about the bigger picture. The bigger picture here is if they keep doing that and they don't stomp out inflation, and if they just pivot here, I mean, really, you're just kicking the can down the road. But they may be forced to do that. Okay, they might feel forced to do that. You know, and I think that's a very good chance. It happened in the 70s too. If you look at the media back in the 70s, when we had the original great inflation. Let's actually go back. It's worth looking at. So since this is the end of the month, we're also going to be looking at the monthly charts. And this is where I like to look at the longer trends, like the multi-decade, multi-year trends. If we look at the 70s, the same thing happened too. You know? We had here, inflation started actually in late 60s, all right, in the late 60s. And then we tightened for a bit. Oh, but it was too much. It was too much. And they said, oh, you know, the economy, you know, and we got to bail people out. And very similar type of messaging. They didn't call it a bailout back then. They called it something different. But, you know, in essence, it's the same principle. And they had to ease financial conditions. Financial conditions eased, and then inflation came back, but it came back worse. They would ease again, and then Volcker, this was Volcker right here. Volcker was put as chairman right here, okay? And, you know, the market front ran, but then we had a huge economic recession, and then we started the cyclical bull market again, all right? So I think that's very likely. That's something that we might see here too. I think it's more and more likely that will happen. And I'm willing to even say that, hey, for long-term DCA, this is a good point. All right. You know, and you know, if you guys are DCAing and trying to get 100 shares of SPY, you know, from Theta Thunder, I know some of you guys were inspired to buy SPY after watching the Theta Thunder and, you know, seeing how you can produce yield by selling covered calls. You know, this is a great opportunity, I think, to be able to do that. If you buy here, just know that we may be visiting these levels even lower maybe 2 or 3 years from now, maybe even next year. It could be even next year. We might even bounce end of the year, maybe touch all-time highs and come back down at the end of the year. All right. I think if this happens, and if this happens, if the Fed pivots and everything, we are probably going to revisit these levels either in 2023 or 2024. I just don't know when. Okay. So just keep that in mind. If you guys are DCAing into SPY, just know, you should probably be, selling calls, getting that yield, but also protect yourself. Get some hedges. All right. Because I do think that if they do pivot, it's really kicking the problem of inflation down the road, and it will come back worse. If they do pivot, it's almost certain that we will have greater than double-digit inflation. We will have 11, 12, 13, up to 15, maybe even more. I don't know. But we'll have much higher inflation. If we're at 7, 8, 9% now, imagine what it's going to be when inflation comes back way worse. And it always comes back worse. I mean, even in the 70s, the second round was way worse. The second round of inflation was way worse. All right? So I think... prepare yourself, all right? But I do think we're going to see a rally first, all right? So October, November, I will position myself for that if we can get good enough entries to see that pivot and to see a rally into the end of the year, okay? I feel more strongly about it now after speaking with them. I do think so. But still, I'm still going to manage risk. I'm not going to go all in on it. You still have to manage risk, no matter how sure you are of something. You still want to have cash just in case. I will stay hedged still, but I will try to position myself for positive delta. Okay. But that is still a ways away. I believe the next FOMC is what, November 2nd? So we got more than a month. Okay, anything can happen between then. We could go a little bit lower first and then up. Who knows? Okay, we'll take it 1 day and 1 week at a time. All right. 10-year. This is what it looks like on a monthly basis. All right. So we're just getting back to those pre-QE era rates. All right. Is this, in my opinion, is the market reaction kind of overblown? Yes, it is. Yes, for now it is. I think so. And that's why I think the relief rally is going to be that much more vicious. Just because these rates really aren't that high. It's just they rose up so quickly, from rock bottom rates that there was no yield protection. Like there was not, people who bought bonds here, they weren't making enough yield. Let me see, go to TNX again. They weren't making enough yield to protect themselves from the loss in face value as this was going up. There was no income protection when they bought right here. So that's why the pain feels a lot worse, because there's no yield. They didn't have yield from buying here. They don't have that much of a yield. And that is really what's making this worse. Okay. But as far as, historical standards, these yields really aren't that high. All right. So that's why I do think if the Fed pivots, we'll probably see a big rally. I wouldn't be surprised if the Fed pivots, if we bounce up to, and if our liquidity data also improves. If our liquidity data doesn't improve for whatever reason, even after that, that means we got some bigger issues. That means there's some much bigger systemic issues then. But I highly doubt that. I think if the Fed pivots, our underlying data is going to probably increase drastically too. It'll be a quick change. But if you look at some of our, the 5-year, if you look at the daily chart, for the last couple of days, it has stabilized. All right. This is not just going up and away. The yield on the 5-year, the shorter term yields. They're actually stabilizing a little bit. So already internal data is already starting to, I'm not going to say it's starting to look better, but it's starting to stabilize. And we'll see what the junk bonds ADL line and the New York high low, we'll see what they say. The New York high low too is also registering less extreme numbers too. So it's stabilizing. Okay. And if our internal data starts getting better and the Fed pivots, then yeah, I can definitely see us getting over all of this, maybe even up to the 4,500, maybe even all-time highs. We could. All right, that could just be the extended rally. We were talking about this. Remember back in June, we might see a mini bull market within a bear market trend. Okay, so this could be like a full retrace. And then when inflation comes back again, which I do expect, if they pivot and kick the can down the road, especially here when inflation's at 7-8%, the CPI is probably going to come back to double digits if they kick this can down the road. All right, and that's when we can see another down movement, back to lows again, or possibly even lower. I'm pretty sure the NASDAQ will see lower numbers in the years to come. I'm pretty sure. Based on interest rates, it's still, a lot of stocks in the NASDAQ are still overvalued. Based on interest rates. Based on, the modeling for equities. If interest rates get to like 5, 6, if 10-year gets to like 5 or 6% on the next round of inflation, I mean, we are going down to 8,000. That's the valuation. That's fair value is 8,000. So in a bear market, as interest rates go up to 6 or 7%, definitely NASDAQ, we could see it touch 8,000, 9,000, 8,000, something like this right here at some point, 2023, 2024. But it won't be a straight line there from here. It'll probably bounce up first after the pivot and then have a vicious cycle down. When? I don't know. This is around the time when a lot of other countries, emerging market countries, will have solvency issues too. So it's actually funny that it's the developed countries that are having solvency issues. Right now it's Japan, the UK, not so much the Eurozone yet, but Eurozone's pretty close. China also is very, very close. China, actually, speaking of debt and the currency exchange screwing you over, a lot of Evergreen, I believe Evergreen, most of their bonds, most of the debt is issued in dollars. So if you're Evergreen, you now owe 20 or 30% more just because of the currency conversion. Imagine that. Your debt just increased by 30% just because your currency just went, just because the currency in which you have to pay has went up. Imagine that. All right. So there's going to be some issues, solvency issues, this issue. So the Fed may be pressured, and in the end, the Fed is not the Fed as an institution, but the the board governors and Jerome Powell. In the end, they're bureaucrats. Okay. In the end, they represent the government and they represent the member banks. If there's solvency issues, they're going to be pressured to pivot. All right. And again, from my conversations with some of the people that I know in my inner circle, they are privately talking about doing some lobbying for that. We shall see. Okay. I do think, though, back in the 70s, again, history, it rhymes. All right. History rhymes. Back then, it was a similar situation. The first few Federal Reserve chairmans, they didn't stomp out inflation all the way, all right, and they pivoted too early, too soon. There has to be pain in order to get through this, okay? History has shown us that. There has to be pain. But I think right now, a lot of people don't want to face that pain. You need someone like Volcker, who just doesn't listen to any of that. But I think Jerome Powell is somebody who listens, okay? He's somebody who listens to the people he represents. He represents the member banks, okay? The federal board, the Federal Reserve Chairman represents the member banks. The Federal Reserve governors represent the government. All right? And they all work for the bond market in the end. So I hope that helps. Let's see if you guys have any questions. Any of you guys have any questions? When's the next inflation numbers? Go to our Discord. All right. In our Discord, we got the countdowns channel. Boom. It's right there. I put a countdown on there. All in your time zone. You see that? Thumbs up, thumbs down. Okay. All right. So that is that's what I had planned for today. As far as that portion. Now let's talk about the longer term trends. You know, we already saw some of the longer term trends. The dollar. You know, if you think the dollar is done going up, I think after, you know, maybe if they pivot, yes, the dollar could retreat a little bit because, you know, they're intervening. But at some point, if inflation comes back harder and interest rates have to go up more in order to contain inflation, we could see a lot higher. I mean, this is not that high. I mean, you know, people, you know, they just look at the, you know, just zoomed in charts on the daily chart. But if you look at the monthly chart, if you go back decades, the dollar was higher, okay? A dollar was a full 50% higher back in the 70s and 80s. That's why I studied this so much, because I think we're in a period just like this, all right? And as you notice, it wasn't a straight line up either. Look at that. There were moments where it pulled back. Back here too, remember? Inflation started here. TradingView doesn't need to show you the data, but I've seen, you know, other charts. So, you know, okay, fine. Let's just assume that that doesn't exist. But it was a lot lower here before, and then it went up like that. So even here, it went down. It went down for a couple of years. It looked like it was over, but then it spiked way up. Look at that, right? We might see something like that here too. We might see this go down, maybe even make, you know, drawn out, maybe a lower high, lower low, and then come back up with a vengeance. We could. All right. Definitely possible. Oh wow, look at the Japanese yen. Did it just tank today? Huh. Look at that. Japanese yen is down today. Okay, well, interesting. Anyway, today is for the long-term charts. So there's that oil. Let's look at more of the longer-term charts. You know, theoretically, could if inflation comes back, could we get to a higher level? I think so. We could get to like 140, 150 next year in March or June. It's very possible, I think. All right. So big picture, I mean, you know, there's still a lot of room for costs to go up if inflation were to come back up. Monthly chart on the rate spreads. You know, we haven't seen this type of inversion for a very long time, since before the 2008 crisis, the banking failures. We haven't seen anything like this in a long time. Notice how the bond market, especially the 30 and the 10, predicted 07, 08. Notice how it was like 2 years early. Yeah? These signals tend to be super early. Bond market looks super way ahead. Okay? So, again, that's where my timeline comes from. Why do you think I keep saying 03, 08? I mean, I'm sorry. Why do you think I keep saying 03, 04, or 23, 24, 2023, 2024 as like the really bad years? You know, when like people are jumping out of buildings because it's that bad. Yeah. Why do you think I keep saying that? So, I think this is the precursor to something that could be really bad in 2023, 2024. But having said that, look at this though too. Look at this. Back in so we haven't had this since '06, right? So let me go back to SPX real quick. All right. 06. Look at this. After that signal, we had one of the best bull market years before the crash. Look at that. So, so is it very possible after this pivot, and the Fed, makes a surprise pivot, not surprise to us here at Checkmate Trading, of course, because we're strategic and we're forward looking. But if that surprise, quote unquote, surprise pivot comes, we might see one of the best rallies we've seen in a while. We might see something like this happen here before the bigger crash happens. All right. So just because you get that signal doesn't mean you can't have these big movements up. So again, same thing. Let's go back 30 and 10. We saw this invert here back in February of '06, but then in '06 to '07, we had some of the best bull market years. '06, yeah, right here, '06, February '06, right here. This is when it inverted, just like the levels that we're at right now, and we still saw a very good bull market because bond markets again look way more forward. All right, and then the market actually Lehman fell right here. So the stock market also front ran that moment. Okay, so again, right now we're here. Fed kicks the can down the road. We have a massive rally. And then we can dump. I'm not trying to predict the future here. I'm just anticipating what could be. And I think this is what happens. If the Fed actually pivots, now this is all predicated on that, us being right. Those guys have to be right. I got to be right. We do have to pivot in order for this to happen. Because if we don't have a pivot and there's no Federal Reserve intervention, this is going to keep going up. The vicious cycle continues. This is going to keep going up, and we're just going to have our pain now. Okay, instead of going down the road, I just don't see that happening. I don't think Jerome Powell is a Volcker. I just don't see that. Okay, bank executives, they don't see that either. All right, so at least the ones that I talk to. Okay, they don't see that. So again, I'm gonna position for it. If we get good enough entries, I'm gonna position for positive delta. But I'm going to manage my risk. I'm going to make it so that even in the worst case scenario, if this just keeps tanking, if, Jerome Powell just gets even more hawkish on the next one, it'll be fine. I'll take a loss and move on. So it's going to be a smaller position. I have to think about this a little bit to see what kind of position I'm going to take because of this, because it is such a binary event. It's either going to be probably a big, a complete loss, or it's going to be just huge gains. So I might have to do something super small, like a very small position. All right. I have to think about this. So over the weekend, I'll do some thinking, and on next week's market memo, I will give you guys, hopefully I'll come up with a plan, a risk managed plan on how to play this. Okay. So I have to do a little bit of thinking. I got to do some homework this weekend to see what would be a good play for us, because if we're wrong, it's probably going to just tank. All right. So if we got positive delta and we're wrong and it tanks, then, that means we might not be able to get a favorable exit, or, we may not be able to protect at least that position on an exit. So that means worst case scenario needs to be still bearable, right? Number one job of ours is to protect capital. So we'll see. Okay, we'll see. So that's all I have. We got 20 minutes until the market closes. I really don't see that much. Markets are probably not going to do that much more today. It's the last 20 minutes. The rest of the world's already closed. This will either go, this will probably stay in the same area today. If it goes a little bit up or down, who cares, I think the monthly candle is pretty much in. We pretty much know, unless something ridiculous happens in the next 20 minutes, but it looks like downtrend continues on the monthly chart. All right. And Q, everything just down. But in the big scheme of things, it's really not that bad. All right. If you're a long-term buyer and holder, this is really not all that bad. You're just giving up what? 2 years of gains if you're in the triple Q. If you're in SPY, yeah, it's just 2 years. 2 years of gains. So if you're like a multi-decade holder, this is nothing. Okay, long term. Okay, so your long-term SPY shares. That's why I say this is a good point to entry. If you're a covered call seller and you continuously sell covered calls, the compounding effect of that income that you get is still going to be better to do. Get it now. Now, if you don't have enough to buy 100 shares of SPY, yeah, I get it then. But not a bad point to not a bad spot to DCA though. Again, I don't think this is a bad spot. Again, I have short puts. It looks like I'm going to get assigned if we keep going down. Who knows? If we pivot then and the market just screams higher before October options expiration, then I guess I won't be assigned. But then again, if that happens, then I do foresee or I do anticipate us getting lower prices at some point, because that means interest rates will have to be higher when inflation comes back harder again in 2023, 2024. All right. And if that's the case, if we got a 6-7% 10-year treasury, we're going to see 8,000-9,000 on the NASDAQ. All right, that's going to be fair value. And in these bear market, low liquidity bear markets, it tends to be that we go down to fair value. Okay, it's just there because there's no liquidity, there's no institutional bids until we get to fair value. It's not a coincidence on why that happens. It's because there's no market participants, there's no liquidity, and so in order for liquidity to come back into the market, in order for institutions to bid, they have all these institutions and money managers, big money managers, they have mandates. They can't buy unless they get fair value. So that's usually where we see pockets of liquidity. That's usually where the bear market ends, and right now, based on the current interest rates, the fair value is around, this 3,600 to 3,650. So that's where we saw the institutional bid come in on June, back in June. Now, interest rate expectations are a little bit higher, so we might see fair value come down a little bit. All right. And again, if the expectation is for us to have like 5% 10 years, the fair value on the S&P 500 comes down to about the 3,400 zone. All right. So if we see that expectation come into the bond market, then yeah, we could see the S&P 500 go down to 3,400. But again, if we have 6-7% 10-year, which I think is going to happen 2023, 2024, if we kick the can down the road, again, we might see lower. Might even see lower, 3,200, 3,000 even. But again, all these things have to play out first. All right. So first things first. Let's get through FOMC. Let's see what happens. Let's see what happens with the CPI report, first of all, on the 13th. And then we'll see what happens on the FOMC. So, guys, I hope this was helpful. All right. I'm not a conspiracy theorist. I'm not a sensationalist. You guys know this. But I do think that it's worth planning for a pivot. Because, again, if it doesn't happen, things are going to start breaking now. Okay, things are going to start breaking soon. We're going to have Lehman moments, and I don't think that is a pain that the Federal Reserve wants. I think they're going to abandon their inflation mandate. Okay, they're going to abandon that. Yeah. All right. So that's my thesis, at least. All right, guys. We got 15 minutes until the end of day. Trade safe. All right. And I will see you guys next.